Welcome to Money Matters. I am Emily Johnson, Certified Financial Planner and Managing Director of Polaris Capital Advisors, and I am joined, as always, by the one and only DCrowell of Mortgage Network, and we are here to discuss all things where your money matters. So this week we've had sort of a continuous, somewhat sideways, somewhat up equity market performance, which has been, of course, lovely. Nothing that's really moved the needle all that much, I guess. Not a whole lot of spikes in volatility, not a whole lot of anything. I guess we had a little bit of a spike with the Trump Jr. Announcement about emails. There was a little volatility that day, and then otherwise, it's just smooth sailing. So you could call it summer, you could call it whatever you want, but low volatility, low volume, just kind of going sideways. So there is plenty of other activity, however, in the world markets, and so maybe you would like to bring us up to speed on some of that.
It's interesting, the sideways motion, the quiet, or if not quiet, the trading of the market in a slightly positive or level manner, the bond market trading also slightly positive, but within a tight range. It all has an uneasy feeling to it of when's the other shoe going to drop.
Well, I think the most interesting, and this is again, it's kind of interesting in a rather benign environment, is that Janet Yellen announced, or sort of kind of announced in Fed speak, that there may not be as many increases in the Federal Reserve rate this year as expected, which is good for the market.
Very
sort of surprising, but
very important. And if you take the Fed in its true role, which is as a meta level speaker and controller of the economy, as well as a down in the weeds tinkerer in the economy. At the meta level, that conversation from Janet Yellen was incredibly important. What she's saying is, hey, we've missed our inflation projection once again, and our target once again. Inflation is increasing at about 1.6%,
which is
extremely low.
Right.
And that's year over year. Results are just out, and she's saying, well, you know, we may not need those rate increases after all. And what it really speaks to is an economy at large that cannot sustain. This is where you get into the politics and the world, the big chess pieces being moved around. There are exciting ideas coming out of Washington about tax reform, which the country badly needs. There's exciting ideas and major conflict about health care. None of these big reforms can take place without a certain assumption about the growth in the economy. Otherwise, there's just not enough money. So in all of these things, as Emily and I have pointed out again and again, there's sort of a zero-sum equation behind all of the political speak, which is if something costs $10 billion and you really do want to spend the $10 billion because the thing is worth doing, whether it's aircraft carriers or healthcare or whatever, you have to figure out where you're getting the $10 billion. And that's the zero sum of it. From the Republican end, you'd really like government not to create that money through increased taxation for all kinds of political reasons. And if you're a Democrat, you're inclined to look in that direction. As a Republican, you're inclined to look at the growth of the economy as the source of the revenue.
Well, given that
and if the economy isn't going to grow, then it sets up this very, very interesting...
A dollar that comes out of here, or a dollar that needs to go here comes out of here, it is, so that's the zero-sum game.
And that's the zero-sum game. And if we have 3% growth out for the next 10 years, we really can do some the government, the legislature, the Congress really can do some very interesting things in terms of tax reform, because the revenue stream that the net revenue stream at lower tax rates that come back to the government will still be sufficient to fund universal health care, to fund the military, to fund all the other things that the government has to do.
From the market's perspective, looking at that, because the politics are such a standstill, because it is a zero-sum game and nobody is really able to accomplish anything along those lines right now, it's almost like watching markets in slow motion, or like watching chess where it's just everybody's moving one pawn at a time but doing it really, really slowly. For example, when Janet Yellen had her announcement this week, shortly before, actually I should say, before Janet Yellen's announcement this week, financial stocks had actually started doing pretty well because there was an anticipation of increased rates, an anticipation of greater spreads, an anticipation of a little bit higher growth. Janet Yellen speaks, next thing you know, sort of at a standstill again. Yes, the rest of the market had a nice little bump because we have a little bit more visibility on what those corporate balance sheets and what the corporate P&Ls are going to look like, because they're not going to have more expensive debt, they're not going to have to look at increased costs, et cetera, et cetera. But at the same time, you're seeing the banks sort of took a slight, not really step back, but they slowed their growth.
This is the yin and the yang of it.
Which is not what we want. We actually, even if you own stocks or if you don't own stocks, if you have a mortgage, whatever, you actually do want to see bank stocks do well because banks do lead into the market, and that with that stagnating at that point, with the rest of the market doing well simply because we have greater visibility, it's like we have visibility, but it's not so great. It's almost like if you're a sailor and you're looking out and you have a beautiful, wonderful day, but there ain't no wind. It's like you've got a beautiful day, lots of visibility, but you ain't going anywhere.
If there are 100 different ways to put it. If bank stocks do poorly, it's because banks can't lend money at viable interest rates or cannot find enough customers to lend the money to. So in a slow growth economy, the banks do less well. Conversely, other sectors of the market do very nicely because they're able to borrow money at very, very cheap prices. So what you have is none of this is absolute, or it's just components of the same picture. What you have is a stock market that is at least partially fueled by the fact that money is very cheap, so people can, corporations and investment groups can take positions in various assets with borrowed money.
So once again, it's sort of a continuation of what we saw back in 2009, 2010, 2011, where you see those who actually have funds that are invested are continuing to benefit from it, but the opportunity to get into those investments because we still have low wage growth, because we have not as many good job opportunities, et cetera, it's creating a greater schism, if you will. And I know I sound more like you right now.
And you do sound more like me. One of the other, again, this is all, none of this is cataclysmic, but one of the other mildly troubling things is if you look at the long-term prospects for the economy, the likelihood of the growth rate of our economy exceeding 2%. Remember, we're having trouble reaching 2%. The likelihood of it exceeding 2% gets lower and lower in the out years, in the next decade or 2 decades. Why? Because in order to have an expanding economy, you need lots of other expanding things, like an expanding workforce. Our workforce is aging, not expanding. We are one of
household formations are slowing. They're not slowing anymore, but they're certainly
flat.
Slower than they were previously.
That's correct. Children per household slowing over time.
They're expensive.
And so what you get overall is an economy, is a mature economy, essentially. There are growth economies here and there throughout the world. The United States is not one of them. It's a much more mature economy, unlike Malaysia, unlike Indonesia, unlike India, unlike China, unlike several of the countries in South America that are large, boisterous, growing economies. And that growth comes not just from companies and widgets and ideas and American entrepreneurialism, as much as our politicians like to mouth off about easy stuff. What it comes from is the actual growth, population mix, and population growth in the economy,
Or lack thereof right
or
now.
lack thereof.
Well, we've got much more to discuss on this topic, so please stick with us. We'll be right back in a minute with more Money Matters.